All this data can be conditions in which you create your automation script and your automation logic. So there's many things you could say. Hey, if Bitcoin is at this price and Ether's at that price, and the interest rates come out, the report comes out at this price, move my assets from here to there. And it'll happen instantaneous once the Oracle data and the conditions are met in the same block.
Hey everyone, quick shout out to today's sponsor, Namada. Namada is currently entering phase 3 of their mainnet rollout, so make sure you check it out by following the link in today's show notes. We'll talk more about Namada later today, but for now, let's get started. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. Hey everyone, welcome back to another episode of Bell Curve. Today I'm joined by Josh Tobkin from Supra. This was a really interesting episode where we dug into the architecture of Supra, and how I came out thinking about this was if you have general purpose chains over on the left and app chains on the right, Supra is falling into this ever expanding bucket of purpose-built chains where it's constructed very intentionally to serve one use case in particular. So this was a really interesting episode, and full disclosure, Supra is a Bell Curve sponsor, so thanks to them for making this up possible. Okay, on to the interview. All right, everyone, welcome back to another episode of Bell Curve. Today, I'm joined by Josh Tobkin, the co-founder and CEO of Supra. Josh, welcome.
Really great to be here, Michael.
Yeah, this is really excellent. I appreciate it. Supra has been a great partner of Bell Curve and Blockworks, and I'm really excited to do this with you because Supra is a very unique design. Actually, just getting to work with you guys a little bit more, I've gotten to see a little bit behind the curtain, so to speak, in terms of how you're thinking about designing Supra, the protocol. And there's some very interesting parallels, I think, to other chains out there today. And I want to do the listeners a service and kind of unpack some of the design philosophy behind Supra. So maybe we can start, from a high level. Can you just give listeners a little bit of a description about what Supra is? And then I would love to get into, these two kind of foundational innovations, I think, which is one kind of this like full vertical integration and like full stack design that you guys are employing with your L1. And then I want to talk about this idea of automations. But first, let's start with the high level, just what Supra is.
Yeah, our design philosophy is if a blockchain has enough computing bandwidth to do more than one thing, it should. Now, we call ourselves an all-in-one blockchain. So that's a layer one smart contract platform with native oracles, with native cross-chain communication, on-chain randomness, and the big one that we're rolling out very soon is enshrined automation. So a single stack that can traditionally do what our Oracle or external networks services, but across the same set of nodes. And we do this in a very unique manner.
Mm. Okay, so let's. I think the through line that I want listeners to take away is that I think there's a lot of experimentation right now in terms of L1s and L2s or just developer platforms in general of how open and permissionless do you make it in terms of, hey, we're just going to give you the basic building blocks and we want everyone to come and build every little part of the infrastructure. So we want people to come and build a DEX, an Oracle, a stablecoin, et cetera, versus, hey, we actually want to be a little bit more opinionated and actually own some of the like first, almost have like a first party app approach. And we've talked about this on, we've talked about this on previous episodes of Bell Curve. We've had Eugene of Atlas come on and describe their enshrined oracle. So that's something that Supra is doing as well. You're seeing this with Berachain. They're launching with their own native DEX and stablecoins. So you've got Bex and Honey. And it seems like Supra is taking a very similar approach. So can you just walk us through, how do you think when you're designing Supra, what is it that you want to build and control to give a good user experience versus what services do you want to leave like a blank canvas for other app developers to come in and build? Like, how do you think about that push-pull or tension?
Yeah, that's a great question. So, first of all, we are a permissionless chain. So we can work with our competitors, and we will. And for example, we have a cross-chain communication protocol that's actually bridgeless. We do this by layer one to layer one, just recomputing consensus of the chains that we interact with. But we still will work with other bridge providers, many of them that you folks know. Uh, Now, we are opinionated about our protocols. For example, especially with on-chain randomness or price-feed oracles, we think it's very important that we have strong security guarantees because smart contracts don't know the difference if the data is any good or not. It'll just execute whatever is fed. So we have designed a very robust and fast low latency Oracle protocol. Our on-chain randomness is cryptographically secure. Our cross-chain communication protocol is also cryptographically secure, and the layer one itself is built from scratch. Now, that said, we're actually kind of the opposite thesis of the modular stack approach. Now that said, we have been kind of described as a mega monolith. However, in any like internet global scale system, even though it's a kind of monolithic design, so to speak, there are modular components, right? So our consensus algorithm, Oracle protocol, cross-chain communication protocol, automation, on-chain randomness, even our native DEX, all of these components can be swapped out for something new. So it's a modular unified system. It's a monolithic unified system with modular components.
Got it. Now, how do you think about this idea? I mean, I think this was a little bit of a something that Apple had to figure out as well when they're like the first party versus third party apps. So, which apps, when they were originally bootstrapping the demand for the App Store, right? It's kind of funny to think about now, but there were not very many people that were thinking about designing apps, right? So you kind of had these original first party apps that were designed for your iPhone by the actual Apple team itself. And eventually, I think you saw the vast majority of that be designed by third-party application developers over time, albeit with a strict set of standards that the App Store would enforce. And so, I guess the advantages that I would say you have is you can kind of start from day one with a very nice user experience, right? Like the Supra team, which I know is very top notch. They can kind of build all this stuff and ensure this nice seamless experience. On the other hand, there might be this perception of actually competing with the app developers that you want to come in and build the native DEX or borrow lend or whatever it is on Supra. So how do you think about, is there an eventual transition that you see happening? Like when you're talking to app developers, like are they concerned about potentially competing, like almost like friendly co-opetition with Supra at a certain point? Or, how do you think about that dynamic?
So most of what we do at Super is actually on the infrastructure layer. So we actually view it as we provide really great integrated tools that allow you as a developer do more things. Now that said, for example, we actually don't have a problem to work with a Chainlink or a Pyth, for example, because we're a layer one itself first and foremost. That said, also our Oracle protocol, however, we are opinionated. We do have the opinion that we have the best designs. And that's what we actually think. And we have, this has been accepted to top academic venues through, double-blind peer review processes for computer scientists, et cetera. And it's fast and it's decentralized, and the way that we handle it is has a lot of capacity. Let's put it that way. So regardless of that, though, if anyone wants to deploy, for example, some of these competitors may provide services or data that we don't offer, so we would still love them to deploy. Uh, in terms of on-chain randomness, that is also a service that we offer. We do this through a threshold signature scheme built into our consensus itself. The signing of blocks gives us a randomized seed on a block-to-block basis. We could still have external parties work with us. That's not a problem at all. However, it's just not going to be as fast. And you have really strong guarantees in terms of unpredictability and the quality of the randomness. Furthermore, I mentioned that we are building a dynamic function market maker, our own kind of enshrined DEX as well, right? And are in our own kind of network owned liquidity treasury. These things are going to be uh, kind of available to all developers as well to tap into. They don't have to use this, end consumers don't have to use our services, but we do have this idea of, instead of a constant function market maker, we have a dynamic function market maker that utilizes our Oracle price feed data, which we think has a good chance of limiting things like impermanent loss and better execution. But once again, this is just one service we offer, and we think this tapping into our also kind of network owned liquidity or treasury can allow folks to borrow from the treasury at discounted rates and perhaps have, what I'm trying to say is, if we enshrine these things into the system itself, we actually don't have to charge as much as peer to peer. So we think that this can benefit other DeFi protocols as well. But certainly there are DEXs already launching on Supra that are not related to our existing kind of designs and future plans, but developers know about it. But ultimately, yes, our point of view is that these are tools. You don't have to use them, but they're there, and we spent a lot of time and care to design these. And since we have kind of made them first class citizens into the chain, we can prioritize it. For example, we intend for Oracle data to always land in the blockchain. sometimes in blockchains with high congestion, that Oracle date doesn't make it in, and that can cause problems for DeFi. But since we are enshrining it like this, we can actually prioritize and make sure it lands in every single block. And this, we think, is ultimately going to result into a better execution quality. And execution quality at large is our North Star.
Mm. Okay, so I want to dig into that a little bit, and I want to start to relate some of what we're talking about here on the technical side to some of the broader debates that are happening in crypto writ large. And I want to get your thoughts, Josh, just in terms of like opinionated versus unopinionated design, and where we stand on that. Because for a very long time, the design philosophy of something like Ethereum has been explicitly to be unopinionated and incredibly neutral, and they're trying to make it as easy as they don't want the perception of any sort of opinion to sway like an app developer or someone who's building infra, et cetera, et cetera. Now some of the newer chains that are coming as like layer twos on Ethereum or alternative layer ones or whatever it is are saying, actually, we want to be opinionated because maybe we've seen 10 or 15, we have 10 or 15 years of data right now, we have a better understanding of what users might want, or maybe we just need to differentiate against some of the incumbents. And so I want to actually connect as well this enshrined Oracle price feeds to what Atlas is doing as a layer two, for example. That's a way that both of you are opinionated in the same direction here. So can you just kind of walk us through how you think about like the opinionated versus unopinionated design thing, and then like what are some other what are some other axes of opinionation that Supra has?
Right. So I have a pretty controversial opinion here, which is
Mm,
that, and this is a little bit contrarian, which is that a single expert team is capable of building better protocols than hundreds of ad hoc teams
mm,
that are just kind of coming together. Now, that said, remember, Supra is kind of, even though it's monolithic, it's modular in its components. So if another team, if it's open source, has something better, then we could swap it out and improve our system without affecting the whole entire stack. So, just to kind of talk about our team for a bit, our team is led by Dr. Annika Kate, Kate. He's the inventor of KZG commitments. KZG commitments underpin like Dink sharding as well as EigenDA. Those both wouldn't be possible without his invention. And he's also an expert in cryptography for DKG, distributed key generation, and other things, as well as distributed compute and consensus. When we have folks like that, right, who are very, very, professional and, considered top 1% of the world in what they do. And then you have someone like me who is more of a kind of product guy and kind of idea guy. It's like, hey, can't we try doing it this way? I
mm,
always try to push the limits, but I have someone like him who pushes back, says, well, actually, that's going to break liveness or that's going to break safety guarantees or X, Y, and Z. That's a very good balance between us. And we do have like 10 PhDs full time, computer scientists. And it's a nice blend of what we have at Supra, which is both very rooted in academia as well in science, computer science, as well as like product driven direction. So I know that it sounds a little bit pompous and a little bit, maybe slightly arrogant to say that we do have strong opinions that our protocols are probably among the best for these components. So, for example, um, even though Dr. Kate is the inventor of KZG commitments and they're utilized in data availability approaches, we don't use KZG in Supra for our own data availability approach. We have a different approach that Dr. Kate, you know, obviously knows the other approaches, and we decided to go a different direction. That's only through having a lot of expertise and experience in the space. Our consensus algorithm called Moonshot. Moonshot for classical BFT algorithms are considered the maximum you can take that type of algorithm. And we've also formally verified this through the Microsoft Ivy Checker. So we're very rigorous in what we do here. I'm always pushing to, just like everyone in our industry, how do we push the limits? How do we maximize, throughput while keeping latency as low as possible? And we do this across every single protocol. So many things, including our on-chain randomness, and we'll talk about our kind of native enshrined automation and other things. These are actually zero latency strategies and techniques that actually compound over time to make a big difference for the end consumer. So I would say that we do believe strongly that we have great protocols. And if there is something better, we're always studying, or we're always willing to learn. And since we have built our system in a modular manner, even though it's a monolithic kind of unified system, if there is something better, we can swap it out, and we will if we're allowed to, meaning if it's open sourced or if the licenses allow for it. So,
mm.
our point of view is basically standing on the shoulders of giants and always have humility, meaning we are very quick to change our opinion. If you show me something better, we are very fast to say, okay, let's look into it.
This episode is brought to you by Namada. Namada is the shielded asset hub rewarding you for protecting the multi-chain. Shield your data across any asset and any chain and get shielding rewards for helping strengthen data protection for everyone. To learn more, follow the link in the description below. Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today. Okay, so that's it. So help me. I want to actually, pull out one of the points that you mentioned, which is you might have a decentralized treasury at some point, and so again, just using analogies here, or maybe drawing comparisons to previous chains. In this sense, this actually looks a little bit to me like previously L1s have kind of shied away from having a treasury at the L1 level for various reasons. I think at least in the Ethereum case, because that's seen as not being necessarily like a form of it makes it seem a little bit less money like, I guess, if you have community members that get to allocate funds. But in the hub over in Atom or Cosmos land, there actually was this sort of community treasury like thing. So how would governance necessarily work there? And then how do you kind of think about in general, I guess, Supra as being historically, L1s have been very opinionated on we're a form of money, all the way to something more like we're an operating system. We don't necessarily think of ourselves like that. So how do you kind of think about Supra within that context? And then what is the governance going to look like around the treasury?
Yeah, so we kind of view blockchains as distributed computers, actually, right?
Yeah.
And we actually, to the point of us, we're actually a multi-VM chain. We think, hey, a computer can run Linux, iOS, Windows. Uh, they can run multiple virtual machines. Why can't blockchains? So our fundamental belief is that these are decentralized computers. And to add upon that, and I'll come back to the treasury and governance in a second. Adding to that, this idea of everyone talks about world computer, right? But world computers that don't speak to the outside world, you need oracles for that. World computers that don't speak to other blockchains, you need cross-chain communication protocols for that. World computers that don't have automation, you need enshrined automation for that. So with that said, our general point of view is these are just a new paradigm of computation platforms, right? And has very interesting qualities of trustlessness, etc. In terms of treasury and governance, so what we are trying to avoid, and this is, we're quite vocal that, hey, listen, governance is a lot harder than it sounds or looks, because we're trying to avoid a plutocracy where those with the most tokens make all the rules. So what we are doing is actually working towards a system that's based on merit. So we want folks to have like a soulbound NFT, so type of thing that can accrue reputation over time. That is very difficult to accrue reputation, and that reputation can actually contribute to your vote, your weighted vote. Okay, and we're actually hiring, in the middle of hiring like, political economists, behavioral economists, political scientists, as well as, of course, we already have computer scientists and such, and to really to kind of think through this deeply about how do we create a system that cannot be usurped by those that have more tokens or more value, but is actually more of a merit-based system. Now, one of these things, or towards that agenda, we have actually, we'll be putting out the paper, and we have a demo prototype of the following already, which is privacy voting. So it's like you can vote without revealing what you voted for, so that you can imagine the leaders of these other chains have so much sway and influence, and people are just going to say, "Oh, I'm just going to do what he does," or because I believe his general ethos. And but we actually think it's probably a better kind of voting system, democracy, governance system, if you actually cannot reveal your vote until later, and then it's revealed after a certain period of time. So in that direction, we do, to give you a sense, the system is going to be progressively decentralized. So we have stakeholders, we have the foundation and others, node operators, investors, VCs, some community members that are going to be kind of the initial committee of that are going to make decisions. We have to move fast in the earliest kind of phases. We're only 3 months live into mainnet, but over time, we do want this to be a governance-based system that's based off of merit, reputation, and that we avoid excuse me, that we avoid a plutocracy, but we enable at the same time a liquid democracy. So we can switch your votes to different leaders periodically, maybe every 6 months or once a year or whatnot. Yeah, so that's kind of how we view it, and also the treasury. And I hope we get a chance to talk about how we plan to actually generate revenue for the treasury. Um, that will be decentralized governance space.
Yeah, I'm very interested in that. I think in general with this I've been tweeting about this quite a bit, but I think that in general, you need to have a very strong explanation for why someone will hold your L1 token if your name isn't Bitcoin. I'm pretty sure that really comes down to fees and the yield that you're going to earn on your L1. So, but before we get there, I do want to just one more question to touch on, which is, I'm curious how you think about just enshrining in general. And maybe this is a little bit more relevant for like a more decentralized context. But I think that one of the interesting things about blockchain design thus far, and this is always a little bit of a push pull when it comes to something like standards, is I think one of the things that Ethereum did very well in the beginning, although people are complaining about a little bit now, is creating the ERC20 standard, which allowed you to trade tokens to tokens, and that was really good at the time. But as technology progresses, you're like, ooh, maybe those standards that we agreed upon or the way that we enshrined this into the protocol wasn't actually the best way of doing things. Like people are now looking back even at EIP 1559, which was an extremely popular proposal at the time. They're thinking actually maybe the market would have actually worked itself out here without necessarily EIP 1559, or we could have done it in a different way. So I'm curious, you guys seem to have a very enshrining heavy approach. And I'm just curious, in a space where crypto moves as fast as it does, how do you kind of balance, enshrining things that are, kind of state of the art or cutting edge at the time versus how quickly the technology changes?
That's another great question. So the reason why we did this in the first place is smart contract platforms alone, without Oracle's automation, cross-chain communication, on-chain randomness, they're not as expressive. They can't do that much actually, especially with the Oracle component. Now, by enshrining it, what you end up doing is you actually cut down a lot of latency, and you also so it's a lot faster, and you kind of tighten the gap from time the data was executed. Let me kind of describe the status quo right now. You have a layer one, and then all it does is smart contract execution and value transfers. Then you have a different network for Oracle price feeds, a different network for automation, a different network for bridges and cross-chain communication. Every time you call out to a different network, you add in latency, and you also add more costs because you have to balance more tokens, and you also break the layer one security guarantee. You start to inherit the security of the weakest component that you utilize. So our point of view is like, well, if there's enough compute and bandwidth to do more than one thing, we should. And we also have a very unique network architecture that allows us to do more than one thing at a time. And we do this by randomizing the nodes into subcommittees called clans. We shuffle the nodes periodically to sub-sampled subcommittees called clans. The whole system is called a tribe, and we randomly sample the system to do various services. So it's actually very scalable. And some of our insights include, while the whole system is up to one-third Byzantine nodes, the random sample set only needs to have can operate on these algorithms at the 51% threshold. So the probability that one-third of the Byzantine nodes in the entire system are in the subcommittee that overtake 51% of the nodes in the subcommittee are very low. The probabilities are very low. So this allows us to have multiple compute services running simultaneously in parallel. And this is how we have a lot of, actually, I would argue, the most compute possible of any layer one. And we can run these things together. So once again, our opinion is to enshrine it because it's safer, it's faster, it's cheaper, and it's a single developer experience for the developer in the end, one framework only. Now, back to your question though.
Yeah,
um, yeah. So the how do we feel if there's if we try something and there's something better later, right?
yeah.
So this will have to so in the beginning it'll be kind of the research team's job to push these through, but eventually as we progressively decentralize, we're going to have to put it through governance and decide what to do here. And I'd imagine through this idea of liquid democracy where we can appoint certain leaders for different kind of departments, or agendas of the general ecosystem. That might be research based, technology based, engineering, or economics based. we can kind of delegate your vote to those folks, and they can decide what to do ultimately. And we'll have to be very thoughtful about this. We have to be very careful about this. This is why we're not trying to rush into governance too soon. It's actually way more subtle and complex than it looks.
Mm,
But yes, ultimately, this is why also we think it is important to build in a modular manner. So,
mhm,
unified system, modular components that can be updated and upgraded as we go. Remember, when traditionally in the Ethereum world, when you hear modular, it's actually a different network for each component, different network, different team, different code base, different programming language sometimes, different tokens. That adds latency. You don't have shared security, and you also have a complex developer experience. So modular is good, but we're a unified system, single node network instead of multiple different disparate networks.
mm. Now, Josh, how do you think about, because like let's take the example of oracles. So in let's say an Ethereum or a Solana type context, you have the private market that are competing to produce different solutions. So you might have like a Chainlink or a Pyth or something like that. And the disadvantage of that, as you eloquently outlined, is that because these are all third party vendors, everyone needs to make a margin, and so you might actually there could be one, you might not get this like very nice integrated approach of being able to prioritize Oracle transactions so they don't always land. They might be more expensive than they ultimately need to be. But in maybe one of the drawbacks of the system that you're describing here is once an Oracle is enshrined into the chain, then there are going to be a bunch of other protocols which build upon that Oracle and then end up relying on it. And so when you do want to make changes in the future and you've outsourced it to governance, then it seems like you're kind of increasing the governance load over time as like more and more solutions get built on top of like the portions of the stack that you control. So how do you think about kind of governance load for Supra over the long term, or over time, do you see decentralizing maybe and allowing the free market to compete on some of the stuff that Supra has originally taken and solved on the infrastructure front?
Yeah, so I want to be clear that Super as a permissionless network will allow anyone to deploy anything. So we
Got
can
it.
work with those folks. And
Mhm.
also for the smart contracts, we can use like proxy contracts. So you can just point it to a different contract and try to make it easy as possible for developers to switch out. Yeah.
Got it. Got it. Okay, cool. That makes sense. All right. I want to talk about automation, which is a really interesting idea that, frankly, I hadn't really heard outside of Supra and before we chatted. So, can you just give us a sense of, when you talk about automation as an innovation axis for Supra, what is that? And then maybe we could connect that to that point that we were talking before about the some of the revenue generating strategies for the treasury.
That'd be great. Yeah, so I'm really excited about this, first of all. So layer ones with Oracle price feeds, cross-chain communication are really great. But automation, most blockchains lack this. Usually some external entity or provider has to submit a transaction to trigger a smart contract to do something. And also what we're bringing to the table is what we call zero block delay automation. These are effectively cron jobs, or if that if this, then that, else if kind of micro scripts that we could run at the end of every single block. So we execute the block's transactions, and then at the end of the block, we execute the communities like the retail and like the end consumer can actually set their own automation tasks. And then ultimately at the very end, we set enough execution space for the system level automation tasks. Now these are checked every single block continuously. And because it's executed in the same block or at the end of the block, we call it zero block delay. So if the transactions, the Oracle price feeds, the conditions are met in the same block immediately, if it evaluates to be true, then it'll execute as part of the execution load. So this is first time to our knowledge of any blockchain to do this, and especially combining it with cross-chain communication, on-chain oracles, and automation. The reason why that's so powerful is because with the Oracle data, you can do, sure, we have 500 data pairs. We have, cryptocurrency, FX, equities, commodities. We're going to be bringing other types of data, including world events, interest rate cuts, job reports, and these can all, anything we could, technical indicators, for example, we're really excited about that as well. All this data can be conditions in which you create your automation script and your automation logic. So there's many things you could say, hey, if Bitcoin's at this price and Ether's at that price, and the interest rate cut or interest rates come out, the report comes out at this price, move my assets from here to there. And it'll happen instantaneous once the Oracle data and the conditions are met in the same block. So this is basically zero latency as well. And it's effectively on-chain like almost like on-chain bots, but they're driven through the automation network. They're on-chain strategies that exist in real time, and it's almost like giving the end consumer like high frequency trading tools, because they can actually play with the big boys. What you otherwise would have to do generally is have like a very sophisticated kind of operation to monitor the blockchain, to submit the transaction. You might want to be a node operator or work with a node operator to ensure that your transaction lands. And then also with MEV, you want to kind of position it where you want it to be. With automation, you kind of skip all that. And it's just immediately executed upon the conditions being met. So we're very excited about this.
Okay, so this is super interesting. So I actually want to maybe connect. It seems like at the scale that you are thinking about this is definitely unique, but I want to draw maybe a connection here to the concept of hooks, which some listeners will be familiar with. So this is something that exists around like Ethereum, maybe Uni v4, right? Is kind of premised on this idea of hooks, where you have a bunch of different AMM designers that can build these post-execution if-then statements and solve mostly things like MEV. And actually another like immediately where my brain goes here when you're describing these automations is actually MEV. And so actually another analog might be Osmosis, where they had this proto rev module where the protocol took an opinionated stance on back running as a non-malicious form of MEV, and it was actually revenue that they generated for the protocol. So is that sort of analogous to the way that you're thinking about things? And then I have a couple more questions for you in terms of like the priority stack between like kind of the retail programming and then the system-wide programming as well.
Yeah, I think a lot of us are that have been in the industry for like 7 years plus, like myself and our team. Um, we end up looking at the same things and we solve it in a different manner. I think we all see like, wow, this automation can really improve execution quality as well as just expressivity and more capabilities. Um, I have looked into hooks just more recently.
Mm-hmm.
Not super familiar with it, to be completely frank,
Mm-hmm.
but my understanding is that they don't necessarily run continuously,
Mm-hmm.
um, whereas ours can be run up to a couple times per second because our blocks are so fast. But I think directionally we're looking at the same things as well. In terms of MEVs, we actually have a very interesting approach to MEV as well. Basically what we do is, as I mentioned, we have on-chain randomness, right? And this is achieved through a threshold signature. So our approach to MEV mitigation, I'm not going to say is perfectly solvable, right? I think that's a little bit too far to say, but we think a mitigation strategy is the following: use the on-chain randomness threshold signature as a randomization seed to execute the transactions in the block. So you randomize the execution.
Mm-hmm.
Why is this interesting is there's zero latency here as well. So there's not an external network that's doing fair ordering and then submits the whole thing to the network. That adds latency. It could be seconds. In this case, there's no latency. It's a randomized execution of the transactions within the block. Now, the astute kind of hacker or DeFi connoisseur might say, well, what I'm going to do is I'm going to just spam your blockchain. So we actually have to, and like I'll spam your blockchain to increase the probability of my transaction landing where I want it to be,
Yeah.
right? So we actually have to couple randomized execution with localized fee markets. So it gets prohibitively expensive to spam the same state. So these two things is our MEV mitigation strategy for toxic MEV. But there's also like good MEV, so to speak, right? Where
Mm-hmm.
that's timely liquidations or arbitrage opportunities to keep DeFi balanced. And that's precisely where we actually can leverage the system-wide automation to generate a new revenue stream for the treasury, for the dApps, and for the node operators. We're kind of trying to take away this toxic MEV from the node operators, and they're making a lot of money in Ethereum and Solana, right? We're trying to remove that because that affects the execution quality for the end consumer. And we're replacing it, however, with what we consider to be a much more superior revenue stream. And would love to dive into that more.
Namada is the shielded asset hub rewarding you to protect the multi-chain. Built to give you full control over sharing your personal information, Namada brings data protection to existing assets, applications, and networks. Namada ends the era of transparency by default, enabling shielded transfers and shielded cross-chain actions to protect your data even when interacting with transparent chains. Namada also introduces a novel shielding rewards system. By holding your assets in the shielded set, you help strengthen Namada's data protection guarantees and collect NAM rewards in return. To learn more about Namada, follow the link in the description below. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets.
In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today.
Yeah, let's talk about that a little bit. So I'm trying to remember someone this like transaction generator. I think there's like maybe CowSwap that had this idea as well about mitigating MEV. But I got to go back and double check that. But so talk to me about what you consider like malicious versus more benign forms of MEV, and then how are you preventing like the more malicious? Like I guess I'm assuming when you're talking about execution quality, you're talking about slippage or front running or sandwiching or something like that is maybe the more obvious forms of more malicious MEV. And then what are the more benign forms of MEV that is the right way to think about this as Supra is internalizing this MEV as a source of revenue into the protocol treasury, or is that the right way of thinking about it?
It is. It is. It's correct. Now, I'm not so familiar with what the CalSwap team is doing,
Mhm.
but what's different about us for sure is that it's being done on the layer one itself. It's not an external
Yeah.
service, so there's no latency here. But I'm glad to hear that others are thinking this direction. I do believe one of the co-founders of Flashbots had also engaged me
Mm,
on Twitter, or on X rather, that they also were looking into randomization as a potential mitigation strategy. So I think there's something there, but I think you have to couple it with localized fee markets to prevent the spamming problem. Yes, so yes. So toxic MEV, front running sandwich attacks, back running perhaps maybe not as much, but the that's like the toxic MEV. Just basically reorganizing the transaction ordering for your benefit is basically toxic MEV. I don't think that's actually considered legal in the traditional world, and if we go mainstream, this may have to be addressed. So this is why we're thinking that it's important to address. And also, I just came across. We were at MoveCon in ETH Denver. We hosted it, co-hosted it with Sui, and I just found out that Sui is also looking into different types of MEV resistance strategies as well.
mm,
Um, but what is good MEV, right? That really comes down to timely liquidations and arbitrage. To make sure that DeFi is balanced and that you're getting the execution, ultimately quality and experience that you're hoping for. So the way I look at it is toxic MEV is when the end consumer, like the barometer, the way that I kind of look at it is, or we look at it is that it comes down to execution quality. If the end consumer doesn't get the execution that they thought they were, that's toxic MEV. If they
mm,
get good spreads, not so much slippage, and it's they get what they expect, that's great. That's ultimately what we want, and we think that this creates a positive flywheel where execution quality will bring more on-chain activity, which will generate more arbitrage and liquidation opportunities, which can be kind of handled through the system level automation to as a revenue stream for the treasury, but for the node operators and for the dApps in which this opportunity came from. So
mm.
that's kind of how we're looking at it. Yeah.
Okay. So in terms of as being a source of revenue for the L1 and the L1 treasury, one of the big trends in MEV is at least in more of like a traditional L1 context is that MEV is moving up the stack. So it's ultimately like user flow which is generating this MEV. So it's kind of moving from being internalized to the L1. So maybe like Ethereum or even L2s in this case to the apps, and then ultimately to the users. And so on some of this benign MEV that Supra would internalize, how do you think about keeping that as a form of revenue for the protocol versus returning it to users?
Well, that is the way we look at it is if we do revenue share, and I should mention, for example, arbitrage on Solana, according to a Helios report, was around $142 million last year alone. And that's
Hmm.
probably not capturing everything. It's probably just what they could kind of garner. And then also for liquidations, there's I think tens of billions of dollars of liquidations every year in crypto at large, and there's usually a 1% fee. So both of these can be substantially larger than transaction fees in general. We still have transaction fees, but on the quest towards high throughput, low latency blockchains, actually it's race to the bottom. For transaction fees should be a race to the bottom, so it's a hard business to make. So,
Mm.
but we realize that folks with good execution quality will have more activity, which will do more things in DeFi, which will lead to more arbitrage opportunities that the system level can handle at every single block. We can handle this,
Mm.
and same with liquidations. That fee and revenue, as we mentioned, can get redistributed to the DApp. That DApp can decide if they want to just give it back to the users or whatnot, but at least we'll capture it in a very efficient manner and keep it within the ecosystem. So dApps can put it back to maybe it's a borrow lending protocol, and maybe they want to mitigate impermanent loss. So they can kind of take that revenue to help stifle that. Maybe they just want to redistribute it to their users directly. They could do that as well. But we just want to. We think that dApps need to have a healthy revenue stream. We think if we take away this toxic MEV from node operators, they need to have another thing to replace it. So we're going to be revenue sharing with the dApp where these opportunities came from, with the node operators that are doing the execution, and the treasury itself. That treasury, just so that folks know, if the decentralized governance over time wants to say we're doing buybacks, we can. If they want to say we're going to try to buy the Mona Lisa, we can. If
Mm.
they want to say we're going to reinvest in the ecosystem, we're going to increase block rewards or whatever it might be, we can. The key point though is we want and we think is very important that we have potentially a very lucrative business model to to fund the treasury in the first place. And we think that what's nice about this approach is that it ultimately ends up, we believe, with less MEV, better execution quality, and this creates this virtuous cycle, this flywheel effect where less MEV, better execution quality leads to more activity, which leads to more arbitrage and liquidation opportunities, which can be that revenue instead of being extracted from the network, which is happening on these layer ones and layer twos and and such right now. It's being extracted away, especially on layer ones. We can keep that value within the system, within the ecosystem, and redistribute it. And this is happening on a block to block level. It's like some micro fees, but high volume. This can execute, we
Mm.
think, up to 2 or 3 times per second. So it's
Mhm.
it's pretty interesting as a new revenue stream business model for the network.
Okay, so a couple of follow-up questions on this. So basically, what I just heard, the TLDR there is that you're kind of going to let the apps decide. There's going to be some revenue share in between the treasury and then dApps, and then that I think makes sense, right? For dApps will do what's best into the keep whatever margin I guess they can, but ultimately will probably end up returning most of that to users. It's a very competitive market. That makes a lot of sense to me. Talk to me about how you think about like one of the interesting trade-offs, and it really is a trade-off because you could view it as a positive or a negative, is Ethereum has left its MEV market mostly up to the private market. And so you have a very small set of highly competent, very well capitalized MEV extractors, right? So this would be mostly the integrated like builders that you see. And so on the one hand, the good part of that is that this is the private market and they're highly incentivized to extract as much MEV as they can. So they probably do, and that's probably the best job of extracting the most MEV as you possibly can. On the maybe more negative front is that you don't get to decide how that MEV gets redistributed. So I would guess in the Supra case, just because it's one team and you're not like kind of opening it up quite as much, then maybe you don't extract quite as much MEV. So there's a little bit of like welfare loss there in terms of pure efficiency. But the benefit of it would be that you get more of a say in terms of how it gets redistributed. Is that roughly how you think about it, or no?
Well, so I would just be, I would say that right now, we are one team that's building the infrastructure, but
Mm,
we have, and even Ethereum usually they started with one team as well. You always start with one
yeah.
team. Um, and then also, I just want to point out these layer ones, the benefit of us going so late in the game, so to speak, is we got to stand on the shoulders of giants. We got to
Yeah.
see Ethereum, Solana. Ethereum didn't even have a concept of MEV. They didn't even know it was a thing until later, right? They didn't even realize, oh, maybe having oracles would be interesting. The industry didn't even know that oracles was going to be a big thing until Chainlink came, right?
Mhm.
So we had the privilege of seeing all these things, and we know every blockchain wants oracles. They want cross-chain communication. They want on-chain randomness. So in terms of the MEV discussion, um, we think that it can create a lot of perverse incentives where these extractors are colluding with node operators to reorganize the transactions in the block which is not really fair to their benefit. That's mostly the negative or toxic MEV that we're trying to avoid. And we avoid that with the randomization, localized fee markets, that kind of thing. Uh, and the thing is, we actually think that this system level automation that's executed at the end of the block for auto arbitrage and auto liquidations is going to be by far more efficient than any extractor external party doing this. So we think we can just keep the system extremely efficient, balanced, and just redistribute the value to the ecosystem stakeholders. We hope that this can dominate transaction fees and be a new type of revenue model that can be orders of magnitude larger than transaction fees. And that dApps, we really want dApps and node operators to be healthy economically. We want them to make money, and they can decide what to do with it, to give it to their community or whatnot, or if they have a token, they can do buybacks, whatever it might be. It's important for everyone to kind of win together to keep this healthy. Now, I just want to make this clear that while we are an initial team, we have a very opinionated idea. I want to, and I've told my team, I want to obsolete myself in a couple of years, right? I want our team to be obsoleted, and I want this to progressively become decentralized. But the truth of the matter is, to go fast, we have to have some level of, you know, uh, concentration of talent. Let's put it that way. But we will, part of building up a treasury and kind of really being opinionated about this now is we have I have kind of an econ background as well, and we have a very strong focus on sustainability. We're like, man, these transaction fees and block rewards are not going to last forever, and there's a kind of this contrast between high throughput blockchains where it's actually raised to the bottom for transaction fees. How's supposed to be sustainable? This has been in the back of our mind for years. And when we stumble across, oh wow, we can do system level arbitrage and system level liquidations, and these can be major revenue drivers for the ecosystem. Uh, my key point is that I will feel comfortable and extremely happy if we have a fair revenue driver that's healthy for DeFi and our end consumer that can be potentially very lucrative, because then we have the resources to figure it out and longevity to figure it out, all the other future problems that will come up.
Traders, AI enthusiasts, and degens, listen up. The game is changing, and Desk is leading the charge. To celebrate their launch, Desk is running a trading campaign with 3 major highlights. 38% of their token supply will be allocated to airdrops. They're offering the lowest trading fees on Earth, and finally, they will be running a Desk referral program. The more people you invite, the bigger your rewards will be. To get started, click the link in the show notes below and make sure to follow at Trade on Desk. This episode is brought to you by Morpho. Morpho is the first and only DeFi protocol Coinbase has integrated directly into their main app, giving millions of users access to borrow against their Bitcoin on Coinbase. Just as Web 2 companies like Google, Amazon, and Meta were built on internet protocols, the largest financial companies of the future, such as Coinbase, will build on decentralized protocols like Morpho. Whether you're an individual, fund, fintech, or institution, Morpho is for you. Follow the link in today's show notes to try Morpho today.
Okay, Josh, I want to, as you transition into this sort of starting to maybe begin to wind down here, I want to talk to you a little bit less about the technical side of things and more on like the go-to-market, incentive program design. And, I'm very curious now. There are so many different L1s and L2s today that are all competing for the relatively thin pipeline of applications. So I'm very curious, like even on this, like what is the strategy here that Supra has for going out and recruiting apps? And then how do you think about incentivizing those apps? And you've seen very different approaches on different L2s. I think Sui, you mentioned, I know you collaborated with them a little bit earlier, but I think their foundation is doing something very cool where they're redirecting sort of protocol emissions to different dApps in the ecosystem. So I think there's a lot of innovation that's beginning to happen at the L1 and L2 layer of how do you incentivize different application developers. So, talk to me about how you think about go-to-market, recruiting apps on the platform, and any sort of incentive program design.
Mm-hmm, mm-hmm. So, in addition to the revenue sharing model we talked about, we also have like the last component that we're going to bring to market is called containers. Containers are like they're these almost like L2s or app chains on the layer one itself. So these application developers can create their own ecosystem with their own gas token and set their own gas fee. Well, for example, it might be a gaming container or a DeFi container or a regulated DeFi or RWA container. These containers exist on the layer one, and they have their own gas token. And yes, they have to pay Supra's micro fee, but they can set their own transaction gas and price. So, for example, some transaction on Supra might cost 1/10 of a penny, right? But they might charge 2 cents. That's actually a 20x markup. that margin is 20x basically. That's a new revenue stream for the DApp. The revenue share for auto arbitrage, the auto liquidations, that's another revenue stream for the dApps. So we focus on ways that these dApps can have their own vibrant ecosystems. And by the way, since these containers, these app chains on the layer one itself, so to speak, they're not actually different chains. They just have their own execution environment or execution capacity or space rather that they can own. Since they exist on our layer one, you can have the app chain experience while having these apps be composable and share liquidity. And you can say you can control the access policies, and also you get the benefits of native Oracle, native cross-chain communication, native automation, on-chain randomness built in. You don't have to, otherwise you have to have a external network, bootstrap validator set, and get an external Oracle, pay for it, pay for another bridge. So it's really expensive actually to bootstrap an app chain from scratch. So step one is new revenue models that help them become more sustainable. Number two, we also have an ecosystem fund. We put aside 10% of our tokens and $100 million worth of tokens that will be just deployed over the next, say, 3 or 4 years to incentivize the winners of our super dApp competition. So we're running these competitions. We want to do it every quarter. The first one's about to end, I think, at the end of March, where we'll select the first, maybe top 6 applications, apps and projects and protocols that are launching and deploying. We'll give them some of the ecosystem fund. We'll also introduce them to VCs that backed us and others. And we also have a launch pad and other things that we can, help them with. We already have, before we launched Supra, we had actually created our own gamified learn earn program we call it Project Blastoff. We KYC'd 512,000 people. So, and our email list is like 1 million people actually. So what we can do is we're basically the winners of this dApp will get part of the ecosystem fund. We'll introduce them to VCs. We'll put them onto our our Project Blastoff platform, and we'll kind of move our ecosystems to try out their application to help them launch. Yeah, but really long term. So but ultimately long term, I believe as we kind of bootstrap the ecosystem, get the engine going, sustainable revenue models that can potentially be quite lucrative is really, I think, is going to be the biggest draw for your applications to consider Supra. In addition to the native capabilities that application developers really like, it's like, oh, well, their mind goes like wild. It's like automation with Oracle and cross-chain communication, fast layer one, multi VM support. They can do so many things they can't do elsewhere on a single infrastructure. And that's kind of our point of view here. And we we're gonna pretty much really try to spend some time to work with the winners of the applications, even though folks that don't win the competition. We want to spend some time with them and help foster them, try to build the right relationships and make the right connections for them. It's going to be pretty hands-on, and we're going to try to scale this and to really give a white glove approach to these genius developers, frankly, that are leveraging our tools. Yeah.
Josh, how this was the first time we discussed the container module that you guys have here. How should listeners think about containers relative to something like a roll up on Ethereum, or honestly, the thing that popped into my head when you were describing that is maybe like a subnet on Avalanche, where they've got their own sort of execution environment, but you have native interop as well. So how should listeners think about containers relative to some of these other sort of concepts that they might have heard across other L1s?
Yeah. Sometimes I forget about promoting containers because I'm so focused on the other infrastructure components. But containers is a big deal. They're like your subnet or your pair chain or your app chain or your Cosmos zone or your layer two on the super layer one. We have so much compute capacity that we can actually give you your dedicated execution space on the super layer one. You can basically reserve this much execution, kind of auction or buy it in advance, and then once again in your container you can set your own policies. You can have your own governance. You can say you can decide what type of governance you want to have. You can say which other containers you compose with or not. You can have access policies. You have the key one for developers after speaking to developers is you can have your own gas token and set your own gas fees, right? So it's like having your subnet or pair chain or app chain or layer two, but you don't have to bootstrap the node operator set. And you inherit Supra's layer one security, the Oracle, the cross-chain communication, the automation, on-chain randomness. You get it all. And you can go to market very, very fast. You can start with, it's like, hey, I'm just starting. I just need like 3 transactions per second execution capacity. And maybe
Yeah.
maybe it's only $100, month. But then as you scale, you can acquire more execution capacity for your application. But the cool thing about this is that you already priced up in that example. The transaction fee might be 1/10 of a penny on Supra. You have to pay in Supra as a gas token, but you've marked it up to 2 cents for that transaction. So as you scale up, you're already making 20x margin on that, right? So it's very predictable on your expenses. So it's way cheaper and to go to market and way faster. This is still in development. This is probably going to be towards Q3 of this year. But we've been working on this as a concept in the paper and for like over a year and a half. But there's just so much to build at Supra. But we're very excited about this because you can have your layer 2, your app chain experience, but it exists in the layer 1. And because of that, these app chains can, quote unquote, containers can compose with each other, and you have shared liquidity. So you have shared security, shared liquidity. The performance of Supra's layer 1, built-in external services like Oracle, etc. And you can go to market a lot faster, a lot cheaper. Instead of millions of dollars, you can go to market for a couple of thousand probably. And like I said, you can have any form of governance. You can have your own gas token, etc. And we're going to be working towards kind of an AI assisted container builder, like a drag and drop. Like, okay, I need this type of governance. Maybe it's like a compound governance. Maybe I need some sort of DEX here, AMM or lending protocol. And you can just imagine if you just drag and drop it, and AI is helping you parameterize it. Like, these are the parameters I need to do, and you just deploy quickly. That's what we envision. And yeah, we're working towards that, and we think that we think this is strictly better than kind of rolling your own chain, because otherwise you have to worry about the economics of your token and incentivize node operators. But also, if you need Oracle Bridge automation, you have to pay these other ecosystems, many of which will require $500,000 to a couple $1 million. So it's very tedious and expensive. So we're excited about this as well.
Cool. All right, Josh. Well, this has been a great technical exploration of Supra. Is there anything? Well, I want to, if listeners want to find out more about you or follow you or the work that you're doing at Supra, or apply to maybe any like programs that you guys have open, what's the best way? What's the best way for people to do that?
Yeah, follow us on Supra_labs on X. Our website is supra.com. Yeah, you can find us there. We're constantly looking for hire engineers and researchers, and we have different roles for different things. Yeah, I mean, we're really excited. We're kind of we're trying to really break out into America. John and I, our co-founders, were both Americans, but we started this like 4 years ago, this particular project. And back then we did not have any regulatory clarity. So we did it all. Although our development company is the Delaware C Corporation, we have like a Switzerland nonprofit, et cetera. We were just very uncomfortable to promote hard in America. But now that the tide is changing, John's moving to the States. I'm in the States right now. We do really hope to tap into the US and, really kind of get more known, because actually we're doing a lot of really great things. And I just want to be clear that, we are all kind of, as a Web3 movement, in this together, and we need to learn from each other. And yes, there's going to be competition, and I hope we can compete with class, but ultimately I hope the best ideas win, and that we ultimately strive for, once again, execution quality for the end consumer. Let's benefit the end consumer. It's the only way we can go to mainstream, that they can't be fleeced, constantly fleeced. They have to get the execution they expect. And then ultimately, we do think that the vertical integration of these services will give developers a lot of tools to do things they couldn't do elsewhere, that are going to lead to applications. I mean, for example, Supra's stack with smart contracts and automation in a stablecoin, you can basically build Stripe like that. You can build subscription payment platform gateways. There's many things you can do here. And the final kind of point I'd like to drive home is system-wide auto arbitrage and auto liquidation executed at the end of every single block. We think will be the largest revenue driver for any layer 1 ever. And number 2, we think that the automation tasks that retail and anyone can do will also be the largest gas consumer of any mechanism in Web3, more than human activity. We think that these on-chain strategies, these automation tasks that are run every single block, will be the largest gas consumer mechanism ever. So that's our point of view, and we actually believe this, and we think that this is going to be, we're just entering a new era of blockchain evolution and design, and this would not be possible without Bitcoin first, Ethereum after that, Solana, AVAX, and so on and so forth. We had the privilege of studying everyone, and we will continue to study everyone. And yeah, it's really great to be here.
Excellent. Thanks, Josh. This was a lot of fun. We will have to do it again sometime soon.
Thanks, Michael. Appreciate it.
Cheers.
Cheers.